Welcome back to OK Monday. Today we're diving into the world of mutual funds, index funds, and exchange traded funds. Three popular investment vehicles that often get confused but are very different. Whether you are just getting started as an investor or looking to diversify your portfolio, we're going to cover the pros, the cons, and the costs. So by the end of this video, you should have a good idea of which option might be best for you. Let's get started. Let's begin with mutual funds. A mutual fund pools money from investors to invest in a diversified set of assets, so think stocks, bonds, and other securities. One big benefit of mutual funds is convenience. A single investor doesn't have to pick a bunch of different stocks, bunch of different bonds, other assets that they might want to invest in to create this diversified portfolio. Instead, in a single fund, you can invest in a broad array of investments, which is very convenient from a time perspective. That dovetails nicely into the second pro of mutual funds, and that is diversification. Just by the nature of the investment vehicle, there is a diversified set of assets in that fund, and you are automatically invested in that diversified mix of assets, which is much safer from a risk perspective than putting all of your eggs in one basket. That's where professional management comes in. A professional manager is actively selecting what is included in the investments of this mutual fund. And they are trying to outperform the market, which sounds great, right? Well, there's a catch. Mutual funds charge higher fees to be actively managed. Typically, they're charging 1% to 2%. So if you've got $10,000 invested in a mutual fund, regardless of whether or not that manager was able to outperform the market, they get a 1% to 2% cut, which means of that $10,000, $200 is going straight into somebody else's pocket. Those fees can add up over time and eat into your investment returns. So it's important to be aware of them. What do you get for that active management? Studies show that it is extremely rare for an actively managed mutual fund to outperform a fund that tracks something like the S&P 500. The New York Times found that during a survey of 2,132 actively managed funds, not a single fund beat the S&P 500 in the last 5 years. Zero, not a single one of 2,132. Okay, moving on to index funds. What is an index fund? An index fund is actually a kind of mutual fund, except that it is passively managed and instead tracks an index like the S&P 500. They follow a fixed formula based on a specific index, and so they don't require active management, which means you're only charged, like in the case of VFIXX, which is Vanguard's S&P 500 index fund, they charge 0.04% compared to the 1% to 2% we saw in the actively managed mutual funds. That means if you have $10,000 invested in that fund, only $4 is going to go into the manager's pockets as opposed to $200 in the last case. The way I think about index funds, it's instead of trying to pick a single stock the way you would if you were cherry picking stocks, or the way an active manager might be cherry picking stocks in a mutual fund, instead of doing that, you're sort of betting on the growth of the US economy in the case of the S&P 500. You're betting on US businesses growing over time and being more prosperous as a whole, instead of trying to pick a single stock to invest in, which not even professional managers can do well. Index funds were pioneered by Jack Bogle in the 1970s, who is the founder of Vanguard. And he basically had the idea of, instead of paying these high fees to actively manage funds, why not save on those fees, have them be passively managed, and track some sort of market index, like I keep mentioning the S&P 500. So index funds aren't trying to beat the market, they're just trying to match the market. Another great feature of index funds is their automatic reinvestment. You can set up your account to automatically reinvest dividends, or automatically withdraw from your bank account and invest into a fund so that you're investing without even thinking about it. You just set it and forget it. You can automatically schedule those monthly contributions without additional transaction costs. It's a great way to automate your investment strategy. One thing to note, like mutual funds, so both mutual funds and index funds, the price of them are only fixed once per day. So they only trade at the end of the day when the market has closed, which means you have slightly less flexibility because you can't buy and sell them the way you would stocks throughout the day when the market's open. Okay, next up are exchange traded funds, which are similar to index and mutual funds. They can be either actively or passively managed. But the key difference here is you can trade them throughout the day when the stock market is open. They trade just like a stock. So there's a lot more flexibility, but typically you also have higher transaction costs every time you buy and sell. And so one question, while there is increased flexibility here, I ask, do I need that flexibility as someone who chooses a long-term investment strategy? For most long-term investors, I think probably not. In most cases, you're better off buying and holding instead of trying to time the market perfectly. So while ETFs are great, the question is, do you really need that flexibility? Okay, key differences. Let's do a quick recap of the key differences that we just covered between mutual funds, index funds, and exchange traded funds. Management. Mutual funds are typically actively managed, whereas whereas index funds are passively managed. Exchange traded funds can either be active or passively managed. Fees. Mutual funds typically have much higher fees because they are actively managed. Index funds have much lower fees because they're passively managed. And exchange traded funds, it depends on the fund, whether they are actively or passively managed. But you also have to deal with higher transaction costs because they are traded throughout the day like a stock. Okay, and then finally, convenience. Index funds and exchange traded funds are great because you can automatically reinvest dividends. But index funds are especially good for setting up automated recurring monthly contributions with no extra transaction fees. So which one might be right for you? If you prefer hands-off investing and want to know that a professional manager is kind of cherry-picking things, and are fine with the extra expenses, mutual funds might be right for you. If you're looking for low fees and a simple long-term approach that you can automate, I would suggest that index funds might be right for you. And if you want the flexibility of being able to trade throughout the day, then an exchange traded fund would be right for you. But remember, there's no one-size-fits-all strategy or approach. Please take into account your own goals, your own preferences, and how hands-on you want to be when choosing which option is best for you. So whether it's mutual funds, index funds, or exchange traded funds, knowing the differences can help you make a smarter decision. If you found this video helpful, don't forget to like and subscribe. I'd love to hear in the comments which investment vehicle you think is best for you, mutual funds, index funds, or exchange traded funds. I'd love to hear from you. Thanks for watching, and I'll see you in the next one. Bye-bye.